Hello and welcome back. You're tuned into Market Fatafat, where we are getting you all the buzzers in trade. So let's resume then. Now on the technicals, we're joined by Ruchit, who's joining us on the technicals, and from our research team, of course, we're joined back by Ravinder and Kanishka. Hi Ruchit, good afternoon to you. Thank you so much for joining us. Ruchit, you picked out Max Health for us. Tell us, what do you see on the charts for Max Health? If I look at the chart for Max Health, again a counter that's doing very well in today's trading session. Over the last 6 months, also decent 15 odd % returns that it has given, but it has been consolidating in the last few weeks. So from here on, where do you see the stock headed?
Yeah, hi, very good afternoon. Well, we have seen that recently the stock had given a breakout from its long consolidation phase in the month of June. And in this entire consolidation, 1200, 1240 was the range where previous resistances were there. So the breakouts were supported by good volumes. The stock rallied higher towards 1320, and now along with the broader markets, we have seen some pullback in last 4 or 5 trading sessions. But the good thing is that on this pullback move, there is no volume-based selling happening over there. So generally, we see that previous resistances tend to act as a support. So we think that the price-wise downside from current levels is very limited. And as it is, even if you see the sector as a whole, then the pharma and the healthcare sector looks bullish from current levels. So Max Healthcare believe that if one is looking from any positional perspective, then 1200, 1240 is a good range to create some fresh long positions over here, keeping a stop loss below 1160 and expect an up move towards 1320 kind of level very soon.
We could see levels of 1320 on Max Healthcare. That's the word coming in on the technicals. But let's shift focus to a whole host of chemical stocks that are in focus today. And this is on the back of the commentary that came in from BASF, which is the world's largest chemical producer. They've given subdued commentary on demand outlook for the months to come. In fact, they've lowered their full-year outlook. They've cut their EBITDA forecast to $7.3 to $7.7 billion versus 8 to 8.4 billion euros they had given earlier. Now, they are saying weaker than expected global economic growth and reduced demand for its chemical due to US tariffs continue to weigh heavy on demand outlook going forward. The company has also said that in calendar year 2025, market demand for chemical products will likely grow less than previously expected. So BASF, it has gone ahead and lowered its guidance, both revenue front and EBITDA front. All of these chemical stocks in focus on the back of this.
Alright, moving on then to the next counter that is in focus today, and that is Ola Electric, which is in focus. Now remember, Ola Electric has posted its Q1 numbers, and Ola Electric shares climbed as much as 17%. In fact, it has cooled off from there, but nonetheless trading with gains of almost 15% in trade today. Even as the company has reported a wider consolidated net loss of 428 crores for the quarter ended June 2025. The rally surprised many, but behind the headline loss, the company has delivered a series of operational wins that signal a possible inflection point in the journey of its profitability. And despite a year-on-year drop in revenues, down 49.6% to 828 crores from an earlier 1,644 crores, Ola has met its top-line guidance and reported a sequential growth of over 35% from rupees 611 crores in the March quarter. Most notably, the company's auto segment has turned EBITDA positive in June, a first for the EV maker. Now, the auto segment's EBITDA has improved sharply to 11.6% as compared to Q4 of FY25. Now, the gross margins meanwhile improved to 25.8% from an earlier 18.4% on a year-on-year basis. On the back of its Q1 results, Ola Electric in focus today, up nearly 15%.
Okay, so Ola Electric is surging in trade today, up 15% as we speak. But let's put the spotlight on the pharma sector then. Divi's Laboratories, on the back of some news piece, the stock has recovered from the lowest point of the day. But Ravinder, despite that, sitting with a cut of nearly 1%. Tell us more.
Well, as Divi's Lab is in focus, where Novartis loses a bid to block US Entresto generic through 2026, and Indian drug maker MSN has reportedly won a patent litigation battle involving Entresto, the blockbuster heart failure drug market by the Novartis, and the ruling clears the way for MSN to launch a generic version in the US as early as 15 July 2025, and development that cast a shadow over Divi's custom synthesis business, where Entresto API is a significant revenue contributor. And as per brokerage, IFL Security has flagged that this patent expiry could shave off 12 to 13% from Divi's EBITDA in the coming year, and the firm has maintained a reduced rating on the stock, assigning its target to a price of 5,465, implying a downside of around 20% from the current level. So back of this, Divi's Lab is in focus, and the stock was down by 3 to 4% in the early trading session, though stock has recovered 2.5% to 3% from day's low, but still trade in red, and the stock is down still more than 1%.
Alright, keeping with Divi's, commenting on Divi's, Aditya Khemka, the fund manager of Incred Asset Management, says that the company's earnings may see an impact, and he also feels that the company's capex will support in the long run. Let's go across and listen in to his take.
For Divi's, I think yes, Entresto is a very key product for them, and will be a substantial part of their earnings. And once Entresto goes generic, some of those earnings will obviously evaporate. But let's not forget, Divi's has done a substantial amount of capex over the last 4-5 years, and that capex probably still has some steam left in terms of monetization. So as and when the incremental capex that Divi's has done gets monetized, the earning growth might still not be a challenge for Divi's. Having said that, on a valuation standpoint, I think we are still very, very cautious on stocks like Divi's, where valuations are overstretched compared to their own historical averages. These stocks are trading at 40-50% higher than their historical average valuation multiples.
That's the word coming in on the entire pharmaceutical sector. But let's also put the spotlight on one more stock from the same sector, and that is Piramal Pharma. Piramal, Ruchit, the stock is up nearly 2.5% in today's trading session, although it has done barely anything over the last 1 month. But from 206 odd levels, where do you see the stock headed on the charts?
So we have seen a decent consolidation in the stocks in this last 1.5 months, along with the broader pharmaceutical space. But the stock is now consolidating around its major support level of around 200. And if you look at today's volume action, then compared to its daily average, the volumes are quite good in today's session. Now the 200 EMA for the stock is placed around 208, and if the stock manages to surpass this 208 to 210 on a closing basis, then we could see a decent run-up move in the stock in the short term towards 224 or 225 kind of range. So one should keep this on the watch list. Above 208, one can look for creating fresh long positions for potential targets around 224 with a stop loss below 200.
All right, so that's Piramal Pharma on the technicals. But coming to you, Kanishka, you've picked out rights for us. Tell us why have you picked out rights? Why is that counter in focus today?
That's right. So rights is in the spotlight after the PU secured a turnkey contract worth about 47 crore rupees for the construction and renovation of government first-grade colleges in Karnataka under the PM Usha scheme. Now, this project, initially planned on a project management consultancy basis, that is PMC, has now been upgraded to a turnkey model, covering a total project cost along with rights fees. Now, the work will be executed over a 36-month period. Now, this follows rights a recent win of $2.9 million in international contract in Guyana for construction supervision, further strengthening its order book. Now, if you take a look at how the stock is performing after the announcement, it continues to trade in the green, up about 0.2%.
Stock is trading with gains up 0.2% as we speak. But let's also put the spotlight on Adani Energy then, and the news came over the weekend where the board has allocated 6.31 crore convertible warrants to a promoter group of the company. Remember, Ardor is a member of the promoter group of the company, and nearly 6.31 crore warrants have been issued. The issue price of this stands at 1480 rupees per warrant. So on the back of this fundraising plan that the company has done, the stock is in focus today, gaining 0.3% as we speak.
All right, moving on then from Adani to the next set of counters. First is the CESC. Ruchit, you picked out for us. Tell us what do you see on charts of CESC? The stock is all up 3% in today's trading session. In fact, the stock in the last, it has. Do you see a breakout coming in on the stock, because it has substantially picked up in today's trading session? What do you see on the charts?
But there has been a good relative outperformance compared to the mid-cap space in CESC if you look at last few trading sessions. Firstly, a high top, high bottom structure has consistently been there since last 2.5 to 3 months. and any kind of minor dips are coming that are getting bought into. Now today and yesterday the stock has managed to form a good support around its 20-day exponential moving average support and have shown signs of a resumption of uptrend from current levels. So I believe that considering that the stock has been an outperformer in this uptrend, so one should expect a continuation of the uptrend from current levels until this 173 supports are intact. We can expect the stock to rally towards 188 to 190 kind of range.
That's CESC on the charts, but let's move on to the next set of counters, and that is the pharma pack. Now, Morgan Stanley has initiated a coverage on India's 4 large Sun Pharma. Now, the brokerage expects earnings growth across the pharma sector to moderate during FY25 to 27, though the robust balance sheets could support the investments in high growth areas like peptides, biosimilars, and specialty drugs. And the firm has an overweight rating on Sun Pharma, citing its strong specialty pipeline, focus on chronic therapies in the Indian market and solid financials. Now, it has set a target price of 960 rupees per share for Sun Pharma, but for Lupin, they have maintained an equal weight with a target price of 2096. Now, Morgan Stanley sees a strong first half for FY26, but flags potential downside due to intensifying competition in the US market. Both Dr. Reddy's and Cipla are also expected to go through a transition year in FY26, with revenues from G Revlimid tapering off. Now, Dr. Reddy's is also rated equal weight with a target price of 1,298, and Cipla is the least favored amongst the pack of Morgan Stanley's picks, as brokerage gives it an underweight rating and a target price of 1,400 rupees.
Okay, so a whole host of pharma stocks in focus on the back of that Morgan Stanley report, but we need to slip into a very short break. We'll discuss many more buzzers on the other side. Don't go anywhere.
Welcome back. You're tuned into Market Fatafat, where we're getting you all the buzzers in trade today. Let's resume then, and coming to you, Kanishka, you picked out the entire power pack for us. Tell us what's powering these stocks.
That's right. So power stocks are in the spotlight today after the government announced a major relaxation in flue gas desulfurization, that is FGD norms for coal-based thermal power plants. Now, as per the latest notification, plants located beyond 10 km from cities with over 1 million population are now exempt from mandatory FGD installation, a move that applies to nearly 79% of India's thermal power capacity. Now, this decision is expected to lower electricity generation costs, reduce the compliance burden, and also ease pressure on power companies. So, plants in the NCR and major urban centers will still have to comply with the rules by end of 2027, while units in critically polluted areas, they will be reviewed on a case-by-case basis. Now, this move is seen as a positive for companies like NTPC, Tata Power, Power Grid, and others, as it helps avoid heavy capex and operational disruptions, improving the overall profitability outlook in the sector.
Okay, so the entire power sector in focus on the back of these new guidelines, but shifting focus to Crompton Greaves consumers then. Rabinder, why is the stock is in focus? Is it on the back of an order win, or I believe it's a brokerage report?
Well, as on back of brokerage report, Crompton Greaves consumer is in focus. The Kotak Institutional Equities has come out with a note, and they have maintained their buy rating with target price of rupees 410. They say that the Crompton's foray into solar rooftop space hold promise, and the PM Surya Ghar scheme has covered only 15% targeted households so far, and the category is currently dominated by the unorganized players. The Cromptons can leverage its extensive network, brand trust, and bulk sourcing capabilities, and the lack of price discovery may work in Crompton's favors. They say that the Kotak say that if the executed well, the category could generate rupees 4.5 billion of sales with the 8% EBIT margin by FY28, and will likely to be ROCE accretive for the company. So, back of this note, Crompton Greaves Consumer Electric is in focus, and the stock is holding a gain of more than 0.5%.
Alright, moving on then to the next counter, and this you picked out Nippon Life India Asset Management for us, Ruchit. Tell us what you see in the charts for this one.
So broadly, we have seen that a couple of AMC names such as UTI AMC, Nippon, and even SDFC AMC, the sector as a whole has seen a good trended uptrend recently, and that uptrend still continues with no signs of trend reversal yet. Nippon AMC is trading around its 52-week highs itself. The 20-day has been acting as a support. The volumes are good along with the price of move. So positionally, we think that this outperformance is likely to continue, and we could see a slow and gradual up move on the high side toward the 840 kind of levels. So the stock has a good support around 780 to 790 range. Until this support is intact, positional traders can look for opportunities for potential targets around 840.
Would see levels of 840 on Tata Motors. That's the technical view coming in from Ruchit. But in fact, Tata Motors, Kanishka, tell us what is the news flow over here?
That's right. So Tata Motors is in focus today after US President Donald Trump announced a steep 30% tariff on the European Union, which is up from 20% announced earlier in April. Now, the move has raised concerns over global trade tensions, especially for auto exporters and multinational players like Tata Motors, a subsidiary that is JLR, which has a significant market presence in both Europe and the US. The street was very closely watching for any potential impact on JLR's exports, pricing and margins, given that EU and US trade forms a very key part of Tata Motors' international business footprint. Now, on the back of these developments, if you take a look at the stock, it's been trading more than 1% lower at this point.
All right, that's Tata Motors trading 1.3% lower, but with that, we completely timed out on this edition. So, Ravinder, Kanishka, and Ruchit, thank you so much for taking the time out and joining us today. We will let you go on that note, but moving on to what Manish Sonthalia, who's Director and the Chief Investment Officer, MK Investment Manager, has to say about the 2 to 3% constant currency growth in the large cap IT names. He also sees strong quarter 4 for mid caps. Let's go across and listen into what else he had to say about the earnings growth.
All in all, large caps would have -1 to +1 sort of a CC constant currency growth, but the better numbers would likely be from the mid-tier players in the IT space. On a sequential basis, the health insurance names would see some sort of an uptick in terms of your profitability. The combined ratio would likely be better than what you have seen in the previous 2-3 quarters. And long-term trajectory in any case remains okay. And the valuations per se are very, very reasonable. Markets would have something to worry about at all points in time. We have never seen a market in my last 30 years where they don't have anything to worry about. Everything is hunky-dory. So having said that, you look at the anecdote as far as the valuations are concerned from the point of view of earnings. Fourth quarter number earnings was the best for the mid cap and the small cap space. And that is where the maximum concern on valuations have been. When the whole Nifty 50 is seeing a low single digit sort of a growth, the better growth numbers are coming in from the broader markets. Overall, earnings trajectory for the mid and small caps are going to be much better even for this quarter. While the Nifty 50 earnings growth is likely to be in the range of 3 to 8%, the mid cap index projected earnings growth is going to be around 22-23%. And even for the small cap index, earnings projection is going to be around 10 to 15%. So it's going to be better than the index per se.
Word coming in from Manish Sonthalia, but moving focus then to an ET Now exclusive where Blinkit is eyeing a new model for businesses. Sellers are looking at a shift from marketplace to inventory-based model. My colleague Anjali is now joining us with all the details. Anjali, over to you.
Blinkit is finally making the move from a marketplace-led model to an inventory-based model starting 1st of September. According to a letter that ET Now has seen, Blinkit informed its sellers about this change in model and stating that this will be effective from 1st of September. Now, under this new model, sellers will transfer their inventory directly to Blinkit, which will be then the seller on the platform. So when you and I go onto the platform to look to buy a product, the seller will be Blink Commerce Private Limited, which is Blinkit. Now, currently Blinkit only offers warehousing and logistics part of the services, but now starting 1st of September, they will also be the seller on this platform. Now, the existing sellers have been asked to accept these new terms by 31st of August, and this has been made possible because the parent company of Blinkit, which is Eternal, became an Indian-owned and controlled company, or an IOCC, in April this year. Now, according to the laws, this allows them to not just connect buyers and sellers, which is a marketplace model, but also hold inventory, which makes it possible for them to transition into an inventory-led model. Now, this offers better margins for the company as well, but requires more working capital as well. The company had communicated their intent to shift to this model earlier, and in the last quarter's earnings call, the Chief Financial Officer said that for this shift, there will be a requirement for an additional working capital to the tune of less than 1000 crore. Now with this shift, Blinkit will not just be connecting buyers and sellers, but will be the primary seller on the platform as well, and will be holding inventory.
Alright, with that, it's curtains down on this edition of Market Fatafat. Ashish and I will take your leave. Thank you so much for tuning in. Don't go anywhere. Market action continues on ET Now.